My name is Michael Grandi. I'm a professor at Providence College, and today we're going to be talking about cost, volume, profit. I'll be using the PowerPoint presentation from our publisher, which is Kimmel, Wiegand, and Queso. This is Accounting Tools for Business Decision Making, 7th edition. And again, this is chapter 18. This is cost, volume, profit, and the class is managerial accounting. Let me share my screen with you so we can start the PowerPoint presentation. And we'll start this from the slideshow from the beginning. And hopefully you should see the screen here. And it's kind of a lengthy PowerPoint presentation, but some of this material we started when we looked at the very beginning chapter from managerial accounting. So as I've always said, that first chapter is the foundation for the rest of the semester. So cost, volume, profit. We've got 5 learning objectives that we're going to take a look at here. First learning objective is that we are going to talk about and define variable, fixed, and mixed costs. Please remember the objective of managerial accounting is planning for the future, estimating, projecting what the future financial situation of our company will look like. And we need to be able to estimate not only revenue, but various expenses as well. So in order to estimate those expenses, we need to understand how those expenses will behave with regard to changes in activity. And activity is defined as sales volume. So the question is, if sales volume changes and fluctuates, what is the impact on expenses? We need to understand what type of expense it is so that we can predict it. And the costs fall into 3 categories: variable, fixed, and mixed. When we get to that mixed cost, we want to be able to break it down into its important pieces. So when we say mixed cost, a mixed cost has a variable component and a fixed component. And the way that we're going to break out those mixed costs is we're going to be using the high-low method to break down the components. That's our second learning objective. And learning objective number 3 is we're going to introduce a new type of income statement called the cost, volume, profit income statement, also known as the contribution format income statement, where we separate out variable and fixed costs. Our 4th learning objective, we're going to talk about how to calculate break-even point. The author provides 3 approaches. I have one that I like to use, and we'll talk about that. And then the last learning objective is we're going to determine the sales required to earn a target net income and determine the margin of safety. So our first learning objective deals with cost behavior analysis, which is a study of how specific costs respond to changes in the level of business activity. Some costs change with activity, others remain the same. This helps management plan for operations and decide between alternative courses of action. Again, the perspective that we have, the perspective we have here is prospective, looking forward. So we're going to spend some time explaining and understanding variable costs, fixed costs, and mixed costs. We're also going to talk about relevant range. So what types of activities are we looking at? Well, activities levels may be expressed in terms of sales dollars, miles driven. I would also say sales activity in the number of units sold, talking about room capacity in a hotel, and various other items. So cost behavior analysis is the study of how specific costs respond to changes in the level of business activity. Changes in the level or volume of activity should be correlated with changes in costs. activity level selected is called activity or volume index. And the index identifies the activity that causes changes in the behavior. For example, direct materials. Direct materials is a classic example of a variable cost. It has a constant cost per unit, and the total cost depends upon the number of units we sell. The more units we sell, the higher our direct materials costs will be. So what are variable costs? Costs that vary in total directly and proportionately with the changes in activity level. So what's important to understand right now is the cost per unit and total cost. Two different things, cost per unit and total cost. So if the activity level increases by 10%, total variable cost will also increase by 10%. Similarly, if the level of activity decreases by 25%, the total variable costs in dollars will also decrease by 25%. Variable costs remain the same on a per unit basis. So one of the things that's very important to remember with regard to variable cost is the cost per unit is constant. In fact, that's the way that you can determine if a cost is variable, because when you calculate cost per unit, it is constant. And again, the classic example of a variable cost is direct materials. If the direct materials cost per unit is $10 per unit, all I need to know is how many units we're going to sell, and I can calculate total cost. Please remember quantity and price. The number of units is the quantity. The price is the variable cost per unit, and I can calculate total cost by multiplying the two together. So here's an illustration. Damon Company manufactures tablet computers that contain a $10 camera. The activity index is the number of tablets produced. As Damon manufactures each tablet, the total cost of the cameras used increases by $10. The cost per unit of the camera is $10 per unit. Total cost depends upon the number of units. This illustration shows total cost of cameras will be $20,000 if Damon produces 2,000 tablets, right? Quantity times price. The quantity, 2,000 tablets. The cost, $10 per camera. Total cost, $20,000. Damon Company manufactures tablet computers that contain that $10 camera. The activity index is the number of tablets produced. Damon manufactures each tablet. The total cost of cameras used increases by $10. We just saw that. Illustration 5.1 shows the unit cost, or the cost per unit of $10 is the same whether they produce 2,000 or 10,000 units. This is a good little graphic to remember here, that the total cost depends upon the number of units, but the cost per unit will always stay the same. What about fixed costs? Now, the classic example of a fixed cost is rent on the factory. If the rent on the factory is $10,000 per month, that's going to be $10,000 per month, whether the company manufactures 1 unit, 10 unit, 1,000 units. The cost, the total cost stays the same at $10,000 per month. In fact, if they produced 0 units, the total cost for rent is still $10,000. Costs that remain the same in total, regardless of the changes in activity within a relevant range. So a relevant range talks about capacity. For example, if our factory can only produce 1,000 units per month, that's 24/7, every day of the week, every hour of the day. If the maximum capacity is 1,000 units per month, that fixed cost of $10,000 in rent per month is only good up to 1,000 units. That's the relevant range. If the company wanted to produce 1,500 units, they would obviously have to rent more space, and the rent expense would therefore increase. Fixed cost per unit varies inversely with activity. As volume increases, the cost per unit declines. So some examples of fixed costs are property taxes. They don't change with activity. Insurance, rent, which we just talked about. Supervisory salaries, depreciation on buildings. So here's our illustration again. Dame & Company leases its productive facility at a cost of $10,000 per month. Total fixed costs of the facilities remain constant at every level of activity at $10,000. However, what you can see here, at 2,000 units, the unit cost per tablet computer is $5. $10,000 in rent divided by the 2,000 units. But when they produce 10,000 tablets, the cost per unit drops to $1. So what's important here with regard to fixed cost is the total cost stays the same regardless of activity. But on a per unit basis, as the number of units goes up, the cost per unit goes down. So here's a question for you, variable costs. Variable costs are costs that vary in total directly and proportionally with changes in activity level. True. B, remain the same per unit at every level of activity. That's also true. So obviously the answer is D, both A and B. Here's a slide on relevant range. Throughout the range of possible levels of activity, a straight line relationship usually does not exist for either variable costs or fixed costs. The relationship between variable costs and changes in activity level is often curvilinear. Fixed costs, the relationship is also nonlinear. Some fixed costs will not change over the entire range of activities, while other fixed costs may change. So you can see here that the variable costs go up as activity level goes up, and the fixed costs have various levels of activity. What you really need to remember about relevant range is that fixed cost is only fixed over a relevant range. For example, that 1,000 unit capacity. Let's skip that. Skip that. So mixed cost, a little bit more complicated, because a mixed cost has both a variable component and a fixed component. Our goal is that once we know that a cost is mixed, we want to be able to come up with a cost formula so that we can predict it. Let's go back. If we know that a cost is purely variable, that is direct materials, and the direct materials are $10 per unit, if I want to estimate total direct materials costs, all I need to know is how many units we're going to produce. If it's $10 per unit and we expect to produce 1,000 units, direct materials cost will be $10,000, easily predictable. Furthermore, if I want to be able to predict rent expense, if I know the rent expense is fixed and it's $10,000 per month, I can easily predict what the rent expense is going to be next month because it's $10,000 per month. I have a cost formula that helps me predict costs. But when it comes to mixed costs, it has both pieces. It has a variable component and a fixed component. So once again, we need to know a cost formula so that we can predict that costs. So this company reports the following total cost at 2 levels of production. So what you see here is you've got a cost at 10,000 units and cost at 20,000 units. So what you see here is that the level of activity has doubled. So we want to be able to look at these costs in related dollars and try to determine whether they are variable, fixed, or mixed based upon the numbers that we look at. So we're looking at direct materials here, and we see that direct materials go from 20,000 to 40,000. Well, the level of activity has what? Doubled from 10,000 to 20,000 units. Well, the direct materials cost, the total direct materials cost has what? It's doubled, right? In direct proportion to activity. It's therefore variable. Let's look at maintenance. So again, our level of activity has exactly doubled, but look at maintenance. It does change. So that means that it could possibly be variable, but it has not doubled. Therefore, there must be a fixed component to it. So this must be a mixed cost. Let's look at direct labor. Again, our level of activity has doubled. What happened to direct labor? Well, it went from 17 to 34. It doubled. Therefore, it is variable. Indirect materials also doubled from 1,000 to 2,000. It is also a variable cost. Let's look at depreciation. The activity has doubled. The activity has changed, but the cost has stayed the same. Let's remember the definition of a fixed cost. Total cost stays the same as activity changes. That's exactly what happened here, right? The activity doubled, but the cost stayed the same. It's therefore fixed. Utilities expense goes from 3,000 to 5,000. Well, if it was purely variable, it would double. It would go from 3,000 to 6,000, but it didn't. So it's not fixed because the amount changed. It is not variable because it did not go up in the same proportion. So it therefore must be mixed. Rent expense doesn't change. It's obviously a fixed cost. So what we want to then do is once we know a cost is mixed, we want to be able to come up with a formula to predict total cost. So we're going to apply the high-low method to determine the components of the mixed cost. The high-low method uses total costs incurred at the high and the low levels of activity. So that's important. We want to focus on the high and low activity level to classify mixed cost into fixed and variable components. The difference in costs between the high and low levels represents the variable cost, since only variable cost element can change as activity levels change. So the first thing we want to do in applying the high-low method is to determine the variable cost per unit using the following formula. Change in costs at the high level versus the low level divided by the change in the activity level. Oh, let's see an example. Metro Transit Company has the following maintenance cost and mileage data for its fleet of buses over a 6-month period. So we see January, February, March, April, May, and June. And they have given us the activity levels for each month and the related costs. So we know that this is a mixed cost. So the first thing we want to do is identify the high activity month and the low activity month. So the high activity month is clearly April with a corresponding cost of $63,000, and the low activity month is January at 20,000 miles driven. So the change in costs, 63,000 minus 30,000, divided by the change in activity, and there's a typo here, right? It should be 50,000 miles minus 20,000 miles, not 200,000 miles. So the variable cost per unit, change in dollars, 63 minus 30 is 33,000, divided by the change in activity, 50,000 miles minus 20,000 miles is 30. So the cost per unit is $1.10. The variable cost per unit is $1.10. So next thing we want to do is to isolate the fixed cost. Determine the total fixed cost by subtracting the total variable cost at either the high or low activity level from the total cost at that activity level. So let's look at the high. The high cost was $63,000. We want to subtract off that which we believe to be variable. So at the high level, they had 50,000 miles. And the variable cost per unit from the previous slide was $1.10. So the variable cost associated with that high level is $55,000. That leaves a fixed cost of $8. Well, just to check the number, we'll look at the low activity level. At the low activity level, they had a total cost of $30,000. Let's subtract off that which we believe to be variable. They had 20,000 miles at that same $1.10. The variable cost, the total variable cost, $22,000. So the fixed cost is $8,000. So now we have a formula that we can use to predict total costs. Maintenance costs are therefore $8,000 per month of fixed cost plus $1.10 per mile of variable cost. This is represented by the following formula. Total cost equals fixed cost plus total variable cost. So if we had 45,000 miles, if we estimated that in a month that we're going to have 45,000 miles, the question is, pardon me, what do we think maintenance costs would be? Excuse me. It's going to be the fixed cost plus the variable cost equals total cost. Fixed cost of $8,000 plus the variable piece, $1.10 per mile times 45,000 miles. Total cost, $57,500. Take a sip of water. Sorry about that. I don't want to worry about a scatter graph chart, so let's ignore that. So here's a question with regard to mixed costs. Mixed costs consist of variable cost element and a fixed cost element. That's true. Fixed cost, all these other things don't make sense. So remember, mixed costs include both a fixed and a variable component. Here's another question for you. Brian's company accumulates the following data concerning mixed costs using units produced as the activity level. So you have March, April, May, June, July. You've got number of units produced and total cost. So they're asking you to do three things. Compute the variable and fixed cost elements using the high-low method. Using this information from part A, write a cost formula to predict future, and then estimate the total cost if the company produces 8,000 units. So before we go to the next slide, let's remember the steps. Step 1, identify the high activity month and the low activity month. Number 2, calculate the variable cost per unit by taking the change in dollars, high minus low dollars, divided by the change in activity, the high activity minus the low activity. That's going to give you the variable cost per unit. And then the next step is you want to calculate the fixed cost by taking the total cost and subtracting the portion that's variable. That will isolate for you the fixed cost. And then you now have a formula. So let's take a look at how they did this. Compute the variable and fixed cost elements using this method. So the variable cost per unit is $1.30. High dollars, so you gotta say which is the high month, high activity month. Is clearly the 9,800 units at March. The low is obviously May at 7,000. So you take the high dollars minus the low dollars, divided by the high activity minus the low activity, variable cost per unit, $1.30. We then want to isolate the fixed cost. So we're going to take the total cost at the high level, which is $14,740, minus the variable piece, which is $1.30 per unit, multiplied times the activity at that high level of 9,800 units, you get a fixed cost of $2,000. You now have you could do at the low level as well and come up with the same number. You now have a formula. Total cost equals fixed cost plus total variable. Or total cost equals the $2,000 of fixed cost plus $1.30 times however many units you want to produce. And the question is, what is the total cost if they produce 8,000 units. It's going to be the $2,000 of fixed cost plus $1.30 times 8,000 units. Total cost is $12,400. So the next thing we want to do is introduce the contribution format income statement, also known as the cost, volume, profit income statement. And this is a study of the effects of changes in costs and volume on a company's profits. It's important in profit planning, estimating what we think profit will be on a go-forward basis. It's critical factors in management decisions as setting the selling prices, determining product mix, and maximizing the use of production facilities. So here are some of the basics with regard to cost, volume, profit analysis. We have what is the volume or level of activity? What's my unit selling price? What are my variable costs per unit? What are my total fixed costs? And what's my sales mix if I have more than one product? These are things we need to know. These are the assumptions that we're working with. So the assumptions are behavior of both costs and revenues is linear throughout the relevant range of an activity index. Costs can be classified accurately as either variable or fixed. Changes in activity are the only factors that affect costs. And all units produced are sold. When more than one type of product is sold, the sales mix will remain constant. So, a question, which of the following is not involved in CVP analysis? Sales mix is involved, unit selling price is involved, fixed cost per unit. We're not worrying about fixed cost per unit, we're only concerned about total fixed costs. So the CVP income statement is only used internally because the income statement we produce for external purposes is the multi-step income statement, not the CVP income statement. This income statement classifies costs and expenses as either variable and fixed. Reports contribution margin in the body of the statement. What is the contribution margin? That's the amount of revenue remaining after deducting variable costs. Reports the same net income as a traditional income statement. So here's an example. Vargo Video Company produces cell phones. Relevant data for the cell phones sold by this company in June 2020 are as follows. Selling price per unit, $500. Variable cost per unit, $300. Total fixed costs, $200,000, and they're going to sell 1,600 units. So we want to construct a contribution format income statement. And this is what our contribution format income statement looks like. It starts with sales. We then subtract variable costs, which gives us contribution margin. We then subtract fixed costs, and we end up with net income. So sales revenue, let's remember quantity times price. The quantity is 1,600 units. The sales price per unit is $500. The variable cost per unit. Well, if we're going to sell 1,600 units, our variable costs also need to be based on the same 1,600 units. The variable cost per unit is $300. Where do these numbers come from? It comes from the previous slide. We have a contribution margin of $320,000. Let's subtract our fixed cost of $200,000. Again, comes from this slide here. Remember, fixed costs stay the same regardless of activity level. Net income, $120,000. Unit contribution margin. So here we looked at contribution margin in total dollars, but we can also look at it on a per unit basis. Selling price is $500, the variable cost per unit $300, the unit contribution margin is $200. And that's an important number as we go forward talking about break-even point. Contribution margin is available to cover fixed costs and to contribute to net income. Formula for unit contribution margin, which we just talked about. Vargo's CVP income statement is assuming 0 net income. So this is how they get to a break-even point. You can go trial and error, right? Because if they had a contribution margin per unit of $200, the question is, how many units do they need to sell to cover their fixed costs? Well, the unit contribution margin is $200. If I sell 1,000 units, I have exactly $200,000 of contribution margin, which cover my fixed cost. Net income is 0. What if they sold one more unit, right? Instead of 1,000 units, they sell 1,001 units. You can see they've added $200 to net income, which is the contribution margin per unit. Contribution margin ratio shows the percentage of each sales dollar available to apply towards fixed cost and profit. Formula for the contribution margin ratio and the computation for Vargo are as follows. You take the contribution margin per unit divided by the sales. You've got a 40% contribution margin ratio. Contribution margin dollars divided by sales price dollars, you have contribution margin ratio. So you can see here, assume Vargo's current sales are $500,000, and it wants to know the effect of a $100,000 increase in sales. So if sales go up by $100,000, the question is, what is the increase in net income? Well, so let's remember, they have a 40% contribution margin. So for every increase, for every dollar increase in sales, there is a 40% increase in contribution margin. And you also know that fixed costs do not change. Total fixed costs stay the same as volume changes. So the fixed costs in this problem are going to be $200,000, whether they sell 1,000 units or 1,200 units. So you can clearly see that if they add $100,000 in total sales and the contribution margin percentage is 40%, they're going to have an increase in contribution margin and an increase in net income of $40,000, 40% of $100,000. So a question regarding contribution margin. Is revenue remaining after deducting variable costs? Yes. May be expressed as contribution margin per unit? Yes. Is selling price less cost of goods sold? No. It's just A and B. Remember, contribution margin is sales revenue minus variable costs. So here's another example. Amco Industries produces and sells a cell phone operated thermostat. Information regarding the cost and sales of thermostats during September 2020 are provided below. Selling price per unit, $85. Variable cost per unit, $32. Total fixed costs, $190,000, and they're selling 4,000 units. Prepare the CVP income statement. Provide per unit values and total values. So you can see sales, $340,000, right? How do they get that? Quantity times price, right? A quantity, 4,000 units, selling price, $85 per unit, $340,000. What about variable costs? Well, again, quantity times price. They're selling 4,000 units, that's the quantity. Times the variable cost per unit of $32, they got $128,000 in variable costs. Therefore, contribution margin is $212,000. The fixed costs, again, given to you at $190,000. Net income, $22,000. And we also want to calculate this on a per unit basis. Sales price per unit, $85. Variable cost per unit, $32. Contribution margin per unit, $53. We don't care what the fixed cost per unit is. So, fourth learning objective, we want to know how to calculate break-even point. Break-even point is that place where revenue equals total costs, both variable and fixed. We can use a mathematical equation, we can use the contribution margin, or we can use the cost volume profit graph. We're going to calculate break-even point in units and break-even point in sales dollars. All three of these are going to be presented in this PowerPoint presentation. The one that I like the best is by using contribution margin. So I'm going to skip this one. So at the break-even point, contribution margin must equal total costs, total fixed costs. Contribution margin must equal total fixed costs. So contribution margin equals total revenues minus variable costs. Break-even point can be computed using either contribution margin per unit or contribution margin ratio. So when break-even point in units is desired, this is BEP units, contribution margin per unit is used in the following formula. So we have fixed cost divided by contribution margin per unit. So it's fixed cost of $200,000 divided by contribution margin per unit of $200. The break-even point is 1,000 units, right? Because 1,000 units times a contribution margin of $200 per unit equals $200,000, which is our fixed cost. Net income is 0. When break-even point in dollars is desired, so what is total sales revenue at break-even point, contribution margin ratio is used in the following formula. It's fixed cost divided by the contribution margin ratio. Total sales of $500,000. So let's also remember this. If the break-even point in units is 1,000 units, and you remembered that the sales price per unit is $500, the break-even point in dollars is $500,000. We don't want to worry about graphs. So here's another example. Goss & Company is planning to sell 200,000 pliers for $4 per unit. The contribution margin ratio is 25%. If Gossen will break even at this level of sales, what are fixed costs? So let's remember, they're selling 200,000 pliers. The sales price per unit is $4 per unit. So they're going to have $800,000 of sales revenue. If the contribution margin percentage is 25%, that's $800,000 times 25% is $200,000 of contribution margin. And they're saying that's the break-even point. So if the contribution margin is 200,000, fixed costs also have to be 200,000 to get net income of 0. And there's your answer. We don't want to use the mathematical approach. Here's another example. Lombardi Company has a unit selling price of $400, variable cost per unit $240. What's the contribution margin? Sales price $400 minus variable cost $240. Contribution margin per unit is what? $160. And fixed cost of $180. Compute the break-even point in units using the contribution margin per unit. Right, there's the 180,000. Divided by the contribution margin per unit, 400 minus 240, break-even point, 1,125 units. Let's skip the graph. Learning objective number 5. Determine sales required to earn target net income, target profit, and determine margin of safety. What is target net income? A level of sales necessary to achieve a target income. Can be determined from each of the approaches used to determine break-even point. Again, I want to use the second one, using contribution margin technique. So this one is very similar to break-even point, because break-even point calculates net income to be 0. Well, if we want to calculate target profit, isn't it break-even point plus the target net income? Formula for required sales to meet target net income. Sales minus variable cost minus fixed cost equals the targeted net income. Again, we don't want to use this approach. To determine required sales in units for Vargo. So the target net profit, they want to have a target net profit of $120,000. So it's going to be the fixed costs that were already there at 200 plus the target net profit of 120 divided by the contribution margin per unit of 200. They need to sell 1,600 units to have a target net income of $120,000. Total sales would have to be 800,000 because remember, it's fixed cost plus the target net income divided by 0.40, $800,000. So the math, we're going to skip that. Let's skip that. So what is the margin of safety? Formula for margin of safety, the difference between the actual or expected sales and the sales at the break-even point. So it's net income or sales in excess of net income. Measures the cushion that a particular level of sales provides. May be expressed in dollars or as a ratio. Assuming actual sales are 750,000 and the break-even sales were 500,000 that we calculated, right? The margin of safety is $250,000, right? It's the actual sales minus the break-even in sales gives you the margin of safety in dollars. Well, what about the margin of safety as a percentage? Computed by dividing the margin of safety in dollars by the actual sales. So you get the margin of safety, which we just calculated to be 250,000. The actual sales was 750. We got a 33% margin of safety. Another question. Marshall Company had actual sales of 600,000 when break-even sales were 240,000. What is the margin of safety? It's 30%. It's the excess, right? 600 minus 420 is 180 divided by the actual sales of 600,000. 180,000 divided by 600,000 is 30%. Here's another example of break-even, margin of safety, and target profit. Zoot Suit makes travel bags that sell for $56 each. For the coming year, management expects fixed cost to total $320,000 and variable cost to be $42 per unit. Compute the following. Break-even point in dollars using the contribution margin ratio, right? Margin of safety and sales dollars. I'm going to take a pause right here. Okay, sorry about that. I'm going to go back to my my screen here. Pick the wrong one up. So I think it's this one right here. Okay. So here's the question. Zoot Suit Inc. makes travel bags that sell for $56 each. For the coming year, management expects fixed cost to total $320,000 and variable cost $42 per unit. So the first thing I'd like you to look at here is what is the contribution margin per unit? It's $56 in selling price minus $42 per unit. The contribution margin per unit, 56 minus 42 is what? $14. Fixed cost $320,000. So what is the break-even point in dollars? So the break-even point in dollars is break-even point in sales dollars equals fixed cost divided by the contribution margin percentage. So in this case, it's going to be the $14 of contribution margin per unit divided by the sales price of $56. So the contribution margin ratio, as we talked about, was the contribution margin of $14 divided by the selling price of 56 equals 25%. So break-even point in sales dollars is the fixed cost of $320,000 divided by the CM ratio. So the break-even point in sales dollars is $1,280,000. The next question, what is the margin of safety? Compute the margin of safety, assuming actual sales was $1,382,400. Oh, what was break-even point? Break-even point is $1,280, $1,382. Margin of safety is $102,000. Margin of safety ratio is what? The margin of safety divided by the actual sales, 7.4%. Soup makes is to compute the sales dollars required to earn net income of $410,000. So remember, this is going to be fixed cost plus target profit divided by the contribution margin ratio, 25%. That's what sales need to be in order to have target net income of $410,000. We're not going to talk about regression analysis. So assume that Hanson Trucking Company has 12 months of maintenance cost data as shown. So we want to use the high-low method. Remember, you want to identify the high activity month and the low activity month, which are clearly high is December, low is July. And the corresponding costs, 63 and 39. So after you determine the high and low activity months, you want to calculate the variable cost per unit. And the variable cost per unit is going to be what? The change in dollars divided by the change in activity. And you come up with 63,000 minus 39,000 divided by 65,000 miles minus 15,000 miles. You come up with a variable cost per unit of 48 cents. You then want to determine the fixed cost from the total cost. So you've got a total cost. We're going to use the low activity of $39,000 less the variable cost at that level, 15,000 miles times 48 cents. You've got a fixed cost of $31,800. And we're not going to talk about regression. And I think that is everything. There you go. So again, we're going to ignore the regression analysis. That's something beyond the scope of this class. Thank you very much. Next video will involve looking at some practice problems.